All right, today we're going to dive into a pretty interesting strategic equity report. It makes a really bold claim. Swiggy isn't just a food delivery app anymore. Nope. The argument is that it has quietly and systematically transformed itself into a diversified, hyperlocal logistics powerhouse. So we're going to walk through this analysis slide by slide to really understand this shift, and we'll look at both the bull and the bear arguments that the report lays out. So the most important thing to grasp right off the bat is this fundamental shift in philosophy. As you can see here, the era of what the report calls unbridled expansion is over. We are now firmly in a period of pragmatic allocation. This is all being driven by a new management mantra, which is basically profitability through discipline. And look, this isn't just some fluffy mission statement. The Q3 FY26 earnings numbers actually back this up. Losses are narrowing way faster than anyone expected, and that's a direct result of focusing on solid unit economics instead of just chasing growth at any cost. And this discipline brings us to the main event, the quick commerce war. You know, the whole story around Swiggy is no longer about just surviving. It's now all about establishing dominance. The key players, as the slide shows, are Swiggy's Instamart, Zomato's Blinkit, and of course, Zepto. They're all fighting for control of the hyperlocal market. What's interesting is the report notes that Swiggy has managed to carve out a near duopoly position in what is clearly a structural growth industry. And that's turned market sentiment from skeptical to cautiously optimistic.
So you might be wondering, how exactly is Swiggy funding this pretty expensive war? Well, this is where things get really interesting. Its original core business, food delivery, has basically matured into what the report calls a self-sustaining safety net. It's stable, it's churning out free cash flow, and it's hitting consistent double-digit contribution margins. So that business is no longer just about growth, it's become the financial engine that's powering Instamart's really aggressive expansion. Now, Instamart's strategy for scaling up is all about something the report calls Dark Store 2.0. And this isn't just about making warehouses bigger. No, it's a strategic move toward larger, more automated hubs that are replacing the older infrastructure. The main goal? To dramatically increase the number of items they can stock, the SKU density, all the way up to 15,000 items per hub. This kind of scale is what lets Instamart go beyond just groceries and push into high-margin categories. Think electronics, beauty, even apparel. And that right there is a critical step for improving their overall profitability. But in such a cutthroat space, how do you keep your customers coming back? This slide points to the Swiggy One loyalty program as a really powerful operational moat. It's incredibly effective at locking in those high-frequency users. What's more, the program creates this seamless cross-selling funnel, guiding customers naturally from ordering food into using quick commerce. And the result of that? Well, it drastically cuts down the customer acquisition cost for these newer high-growth verticals. It's a very smart play.
Here, we can see a key operational advantage in action. Back in early 2025, Swiggy went out and acquired a specialized third-party logistics player. Why? So we could own the middle mile. This strategic focus on owning its own infrastructure paid off, leading to a significant 12% reduction in per-delivery costs. It's a perfect example of the company's big shift toward building a more sustainable and cost-efficient logistics network from the ground up. It's not just about physical infrastructure, though. Swiggy is also making some very pragmatic investments in technology. This slide highlights how they're using AI-driven forecasting. The goal is to minimize wastage of perishable goods, which is a huge inventory risk in the quick commerce business. As the chart shows, when you move from relying on historical data to an AI-optimized forecast, you get a direct efficiency gain that goes straight to the bottom line. This is a perfect example of that pragmatic capital allocation we talked about earlier. So the strategy isn't just about cutting costs. It's also about structurally increasing the average order value, or AOV. This slide shows two new verticals designed to do exactly that: Swiggy XL, which targets bulk delivery demand, and Swiggy Pharmacy, which is for that high-trust, recurring necessity segment. For both of these, the strategic goal is simple: increase the value of every single transaction. And that is absolutely essential for supporting healthy unit economics in the long run.
Of course, it's not all smooth sailing. The report is also very clear about the primary risks, which are summarized here as 4 key headwinds. First, on the competitive front, Zomato has a bigger war chest, a superior cash position, which could let them start a price war. Then you have the Open Network for Digital Commerce, or ONDC, which could put a price floor on take rates. From a regulatory angle, there's always the potential for new rules around gig worker benefits, which could cause costs to spike. And finally, on a macro level, any slowdown in urban spending is going to directly hit order frequency. So these are the big challenges that Swiggy has to navigate. So, where is all of this headed? This timeline lays out the company's very clear path toward full-year profit after tax, or PAT positivity. FY 2025 was labeled the efficiency year. The strong results from Q3 FY26 have pretty much confirmed that the company's on the right track, clearing that path to profitability. The focus has officially shifted from just scaling at all costs to actively harvesting profits, with a stated target for full-year PAT positivity in FY 2027.
And that brings us to the report's final verdict. It classifies Swiggy as a growth compounder for the long term, basically framing the company as a core proxy for India's massive consumption story. The analysis concludes that while, yes, the valuation is at a premium, Swiggy has now proven the scalability of its unit economics, at least in Tier 1 cities. The report's final recommendation is to accumulate during volatility, viewing any dips as a potential buying opportunity. So the question the report really leaves us with is this. As Swiggy completes this pivot from a cash-burning aggregator to a disciplined, profitable logistics giant, will the market finally reward this fundamental shift in strategy?